Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking time out of your busy day to spend it with us. I guess this is our first show for 2025. I want to wish everyone, or at least hope that everyone had a great holiday season. I want to wish everyone a happy new year. I hope you had some time to rest, spend quality time with family and friends over the past few weeks. You know, it's funny, a lot has happened since we last spoke back in December. Obviously, we had our prime minister resign. We've had a lot of commentary back and forth between the United States and Canada. We obviously went through a very busy holiday season. We've seen some new economic data coming out, lots to talk about. And obviously, when there's a lot to talk about, there are a lot of questions that individual investors have for me, in general, that they want answered. And as always, we're going to try to get to and answer as many questions as we can on our show today. So here are the topics that we're going to be discussing. Trump uncertainty makes some investors nervous. This is probably the number one thing on everybody's minds. And when the president-elect becomes the next president in the next few weeks, then we're going to hear from his administration, from himself, as to what he has planned with respect to the United States and what he has planned with respect to tariffs, which we'll touch on a little later in the show. Tariffs that he's talking about applying to goods coming into the U.S. from pretty much everywhere, but obviously from Canada, Mexico, increased tariffs on Chinese goods as well. So definitely a topic of discussion around everyone's table, it seems like. We'll then get into the top 3 things to consider over the next 10 business days. These are 3 areas or ideas that I want individual investors to consider before you make your investment decisions. Is Batman the next stock grouping for 2025? So first we had FANG, F-A-A-N-G, and that's an acronym, obviously. Then we had the Magnificent Seven, the Mag 7. And now we're talking about Batman. It was funny, before we came on the show, we talked about putting on the theme song for Batman when we did this segment, but perhaps we'll bring it up the next time. But Batman, what does the acronym Batman mean? And is it the next group of stocks that you should be considering? Having the right expectations. This is very important because we just came out of another 20+% gain for the S&P 500 this past year. The second one in the row. We had 20+% gains in 2023 on the S&P 500, and again on those gains happened to gain 20+% in 2024. We also saw TSX grow by about just over 20% as well. So having the right expectations coming into this year is really important. Don't think we're going to see gains of that magnitude this year, but I still believe we will have a positive year. Confidence in the markets. You know, we came into 2025 on a high note. Markets were at all-time highs, are still at roughly all-time highs, maybe off by a little bit. And so can you still have confidence in the markets? Can you still have confidence that you can make money in this market? How should you be investing in a market that is at all-time highs and where we see a number of valuations stretched? So we're going to talk about confidence in the markets in North America. Quick hits, part of the show where I talk about another 3 points that many of you may have seen in the news recently. I'm going to touch on 3 of them quickly, give you an opinion, perhaps give you some background info as well, and show some nice charts. Probably one of my favorite charts is in this segment. And last but definitely not least, your questions. If you have any questions during the show, please put them into the chat box. Love to answer them during the show or at the end of the show. If I don't get to them at the end of the show, definitely I will try to answer them over the next couple of weeks before our next show, or perhaps answer them on our next show. So without further ado, let's move on with the show. So Trump uncertainty, and I guess that's the headline, you know, President-elect Trump, or soon to be President Trump. I guess he's not really a new president. We've seen him in the White House in 2016 to 2020. So not a new president per se, but definitely taking over again from President Biden. And I can't tell you how many, I guess, questions I've had about the new president or President Trump going back into the White House. What does that mean for investors? What does that mean for investors' portfolios? And actually had a few email messages, a few calls over the holiday season asking me, you know what, Allan, should we sell our investments or sell partially our investments or maybe sell some of the more volatile names before the inauguration, before President Trump get sworn in and take over and go back into the White House. And people are nervous. They don't know what to believe. They don't know what he's going to say. They don't know what's going to happen with respect to his plan for tariffs and all the other things he's talked about over the last little while. And that uncertainty has definitely played out with consumers, with Canadians. Our first chart here clearly shows this, clearly shows that what's been happening is definitely having an effect on the consumer. Consumers are losing confidence here in Canada. They're losing confidence because they believe that what's going to happen is perhaps not good. If tariffs are put on all goods coming from Canada into the United States, 25% tariffs, could there be job loss? Could businesses be significantly affected by these tariffs? And you could see that ever since the new president was elected back at the beginning of November, confidence, consumer confidence has definitely waned. It's definitely come down. And what I tell individuals about this is you just don't know. We don't know what, number one, is going to happen. We know that the former president likes to say something and then perhaps step back a little bit from his initial commentary. He kind of goes for all or nothing at first and then scales back to perhaps a lesser position on what he is asking for. And we've seen that time and time again when he was in power his first time during 2016 to 2020. He came off as the lion, going for broke, going all in and asking for the world, and then over time scaled back. And perhaps that's his negotiating tactic. So not sure what to think about that. At the same time, I know and that many investors perhaps are letting emotion factor into their investment decisions. Whether you are a Republican or a Democrat in the US or conservative or a liberal up here in Canada or NDP, don't let your political views shape the way you invest. You kind of have to take an unemotional look at your portfolio, at the stock market. And that's where investment advisors should be able to help you. I try to take an unemotional look at all my clients' portfolios, whatever happens, whether you are a fan of President Trump, whether you don't like the way he acts or what he says, etc. You just can't let that affect your investment decisions. Perhaps make you do or lead you to do something you would not have done just because you're not, or you wouldn't be a Republican if you could vote in the US. You'd be more, a Democrat, etc. So I just think that you got to take the emotion out of what's happening the best that you can. At times it's difficult. I realize that. But if you're going to be an investor over the next little while, you really have to look at the facts. So what are the facts? Well, let's take a look at President Trump's last 4 years when he was in office. We have a chart of the S&P 500 going back to 2016, and you can see clearly here that the S&P 500 did extremely well during his first 4 years that he was president. You see over here on the right-hand side, the chart sort of tail off, and that was because of COVID, right? We got into 2020 and everything sold off, and I don't think anyone could blame the Trump administration for that. You want to look now, we have our next chart here, which is again the S&P 500, but this is in the last few months. It shows you what happened when he was elected in November. So this is obviously a shorter term chart showing what happened. And clearly, investors liked what they saw on both sides of the border. Markets went significantly higher from that first week in November when the president was reelected. So clearly, the markets have benefited from President Trump in the White House the first 4 years. And I guess, if you're going to go by history, you would think that the next 4 years perhaps shouldn't be much different. So what we want to do now is, and what we've done, is kind of look at a few pros and cons of President Trump back in the White House and kind of take a look at it from that perspective. So here you have on the pro side. Let's go with that first. Business friendly. We know President Trump comes to us from the business world, a real estate tycoon, being in real estate, and he's written books, and there have been many books on things such as the art of the deal. We know that President Trump is good at negotiations. We know that he is a good businessman, and so he will be business friendly. He will put in place policy that will be friendly to business, big business, small business. And the hope is that all the different policies that the Trump administration puts into place will benefit business. And if it benefits business in the US, you have to believe it's going to benefit business up here in Canada. Because as we know, and as I've said many times on our show, we export about 70%, maybe a little bit more, of what we build and pull out of the ground to the United States. So business-friendly environment in the US will help us here in Canada. Business-friendly, what does that mean? Well, it means lowering taxes. President Trump has talked about lowering taxes down in the US, perhaps as low as 15% for businesses that do business in the US. For businesses that do business outside the US or globally, he still wants to keep taxes low, perhaps 20, 21%, which is still historically low. So lowering taxes, another positive for stock market and the economy. Reducing regulation. What does that mean? Well, cutting red tape. We all know all the different hoops and hurdles that you have to go through and jump over to get things done in Canada, in the US, and in any country. So the president has spoken about in his administration, the people that he's already named for certain positions within his administration, they've talked about reducing red tape, reducing regulation, deregulating, making it easier for people to grow, for businesses to grow, for businesses to merge, take over other businesses, for businesses to go public, and many other things. He's talked about even cryptocurrency, right? We've talked about this on this show before. He wants the United States to be the cryptocurrency capital of the world, which is something that the previous administration kind of stayed away from. And probably the number one thing that I always fall back on when I talk to individual investors that are nervous is this last point. He sees the stock market as an indicator of success. It's his barometer. It's how he measures his success. The first 4 years he was in office, and even recently, he has said that the stock market flourished under his administration while he was president of the United States, leader of the free world. The market did extremely well. And as we saw just a few charts ago, he is correct. Prior to COVID, the economy was doing really well. Stock market is doing really well. So if you look at it in those terms, he's probably not going to do anything that's going to make the stock market fall for a prolonged period of time. Yes, there are things at times that he says or does that have short-term negative effects. But overall, if he's measuring his success based on the success of the stock market, you have to believe that he's not going to do anything that will hurt the markets long term, and in fact, do things to hopefully make the markets move higher. So what do we have on the con side? Well, let's start off with the second point, the unpredictability of the president. It's funny, in the first 4 years, I actually went on to Twitter at the time. I know it's called X now. And I started to follow the president. And you would ask, well, why would you do that? Well, I did that because any commentary that he made was made a lot of times through Twitter. And he would tweet out an opinion, a commentary, and he would move markets that way. Kind of interesting. He would say something. And he's been doing it already through his Truth Social Twitter posts and his Truth Social, his publicly traded company that you could actually buy shares of if you wanted to. But he's been tweeting out a whole bunch of stuff with respect to our first point, which are tariffs. And if you want to know what he's thinking, definitely you should follow him on Twitter. I think you can gain some really good insights, especially if you see the market moving and you're not sure as to why. Possibly because the president of the United States, or the soon-to-be president, tweeted something out. But the number one con, obviously, are tariffs. And we just don't know what that is going to look like. We know what the president or the soon-to-be or president-elect has said about tariffs, but we're still not sure as to what what the tariffs are going to look like, if everything is going to have tariffs put on it. There's been some talk recently about that, which we'll talk about in our quick hit segment, that maybe he's not going to put tariffs on all goods. Maybe he's just going to pick and choose which ones he feels need to have tariffs put on them. So overall, I guess if I had to make a general statement, I would say don't generalize and think that because you may not like the president-elect, his personality, what he says, his demeanor, how he acts, don't let that affect your investment decisions. If you do, it may lead you down the wrong path. There are definitely some pros to the markets, to business of the president-elect when he comes into power. Obviously, there are some negatives as well. So I think you have to take everything with a grain of salt. And that's where wealth management comes in, money management comes in. We need to, and we will continue to react to what the president says going forward. You have to be ready to do what it takes to change your portfolio if necessary, if that's what it takes. But that is what consistent management is. And that's what I recommend. I recommend everybody take a step back and let's see how things pan out over the coming quarters before you make any decisions based on your portfolio because of the new Trump administration. Now the part of the show where I talk about 3 things that I believe individual investors should be looking at, focusing on before you make your investment decisions. And our first point here, jobs, inflation stats coming out for 2025. Our first look at jobs numbers. Well, I guess it would be a December jobs number, right? But it is our first jobs data in January, not for the month of January, obviously, but for the month of December. We're also going to get inflation statistics out of the US next week. We already had some jobs numbers coming out in the last couple of days. JOLTS, job openings, were released recently, and they were actually quite strong. So we're going to get a lot of economic data. Retail sales, another one, is going to be coming out in the US. We're also going to get Canadian jobs coming out on Friday with US jobs data. Number 2, interest rates and the dollar are moving higher. This is not good for the stock market, not good for markets in general. Whenever interest rates are higher, we saw what happened back in 2022. Market doesn't like higher interest rates. We're seeing interest rates moving higher. And with that, and with the weakness on the Canadian side, with respect to everything that's going on here, we're seeing a stronger dollar versus the Canadian dollar. We'll talk about that as well. And lastly, our third point, corporate earnings season is approaching. I have a few stocks that I want to highlight that I think are important to look at for, I guess, a barometer as to how good or how well the U.S. economy is doing. A couple of market leaders, a couple of standouts that I want to touch on. So we will get into that as well. So let's move to the first point, which is economic data. As I said, we're going to get a lot of data coming out in the next 1 to 2 weeks. We're going to get inflation data, as you see here on our image. We're going to get first jobs data coming out in a couple of days. Interesting, tomorrow the U.S. markets are actually closed because of the death of former President Jimmy Carter. I believe he lived to 100 years of age, which is fantastic. But in respecting the president, the former president, I believe his funeral is tomorrow. They are closing the stock exchange. So today, Wednesday, and then we won't be, or at least the markets will not be back open in the United States until Friday, and that's when we get the jobs data. So our first chart here talks about JOLTS. As I said, JOLTS, which are your job openings, and labor turnover is what it stands for, what JOLTS stands for. And as you can see here, that job openings rose to 8.1 million, but yet hirings are falling, and they fell to 5.3 million. So whenever you have more job opportunities or openings than and not really that many people to fill them, or people aren't filling them, that is a bit of a negative for the Federal Reserve or a central bank, because that can lead to inflation. So when you have lesser people chasing all these different jobs, they can demand higher wages, and therefore higher wages leads into inflation. So JOLTS numbers definitely play a factor and something that the Federal Reserve is definitely watching. Our next chart is on monthly job creation in the US. Again, a number we're going to get on Friday along with the Canadian jobs number. We saw the strength in jobs, 227,000 jobs created in the month of November. October was a bit of an anomaly because we had those storms, if you remember. A couple of hurricanes came through and the numbers were definitely distorted, all the destruction that those storms caused. So the jobs numbers weren't accurate for October, but if you look at September and November, very strong jobs growth. And again, a point that the Federal Reserve is looking at with job growth very high. That takes care of one of their mandates, right, which is full employment. And it might lead the Federal Reserve to only cut rates maybe once or twice this year or at all over the next 12 months. They don't see the need to be very quick on the cutting of rates, and that's because job growth has been so substantial. Next chart, retail sales. Retail sales have been really strong in the US as well. And you can see here, we'll pull up, there it is. Monthly retail sales advanced 0.7% in November, 0.5% in October. We'll see what the December numbers look like when you take some of them are counting X autos or not including automobiles. Some of them are including autos, general merchandising. You can see here that retail sales have been extremely strong in the United States, and it's something that, again, another data point for the Fed to consider. Our next chart is actually on Canadian stats, Canadian jobs growth, Canadian employment change. And as you can see, in November, 51,000 jobs were created in the month of November in Canada. Yet our unemployment rate jumped up to 6.8%. It's hard to figure out how that could happen when you're growing jobs at that pace. You figure that Canada is about a tenth the size in terms of population to the US. So 51,000 jobs created would be equivalent of over 500,000 jobs created in the US. So you can see how strong of a number November was. Let's see what December brings. And if it brings the same kind of data, what does that mean for the Bank of Canada? Will they be as quick to cut rates this year? Next chart, U.S. price index, consumer price index, CPI. There you have it. Headline number, 2.7%, still above the target of 2% in the U.S. In Canada, we'll see that number shortly. We're down to 1.9%. So we're at target, whereas the U.S. still have a ways to go. Factoring out volatile food and energy prices, you get a number of 3.3% for CPI, and that obviously is a lot higher than the Fed wants. Next chart we have, which is one we've seen many times, Bank of Canada's key interest rate versus the inflation rate, and there you have it, 1.9% inflation, and 1.9%, yes, inflation, and a Bank of Canada rate of 3.25%, and we've seen this rate come down significantly. What is the neutral rate that both Bank of Canada and the Federal Reserve is looking for? Well, that remains to be seen. We think that maybe the Bank of Canada neutral rate might be somewhere around 2.5%. That would be possible, and maybe they cut another 3 times this year to get us there, or perhaps another 75 basis points, or maybe a full percentage point, get us down to 2.25 by the end of the year. So we'll have to see how that plays out. Obviously, it's playing out in our currency markets, which we'll get to in a second. But obviously, the Bank of Canada is going to do what they need to do to stimulate the economy, and that may mean continuing to cut interest rates. Our second point that I had on our list of 3 is talking about interest rates and the dollar moving higher. It's unbelievable that the U.S. Fed continues to cut rates, albeit when they cut rates, it's more on the short term, but yet all the treasuries, all the interest rates on U.S. bonds continue to move higher. And as I said earlier, not a good thing for the stock market. Here we have the U.S. 2-year. When this was taken, I believe a day or so ago, it was just under 4.3%. I believe that the 2-year actually went above that in the last 24, 48 hours and has pulled back a little bit today. Again, you can see here from the chart, it continues to rise. The 10-year treasury or 10-year bond rate, probably the most important one that we all look at. We know that mortgage rates are set off of that. Look at that one, almost 4.7%. It actually ticked above 4.7% in the last, as I said, 24, 48 hours. And so what we're seeing is interest rates in the US are moving higher. The 30-year bond rate actually touched 5%, something we haven't seen in a couple of years. And obviously with this, with bond rates moving higher, mortgage rates are definitely moving higher in the US. And as we know, this is slowing down. This has the effect of slowing down the economy, certain segments of the economy, like interest rate sensitive parts of it, such as technology, such as real estate. So higher interest rates, not good for the economy, and obviously not good for our economy here in Canada. But we're still looking at perhaps 3 to 4 cuts this upcoming or during this year, 2025. Our next chart is on currency, and you can clearly see what the currency effects have been as we lower rates in Canada faster than the Fed does in the US. Look at the effects on currency. US dollar has surged versus a basket of other currencies. You can see here in the middle how much the Canadian dollar has fallen, almost 8%, whereas the United States or the US dollar has surged about 6.6% ahead. And we're not alone, right? You can see all these different currencies, the euro, the UK, Swiss franc, everybody has fallen by the wayside. The US dollar has continued to gain strength. I've done a few interviews in the last 48 hours on radio right across the country, actually, talking about what has happened with respect to the Prime Minister resigning, the effects on currency, what has affected. And yes, the resignation, and at first, actually, our dollar surged. But then the proroguing of government, now really there is no government, at least at this point, no parliament at this point. I think that is weighing on our currency as well. But nonetheless, the US growing at 3% and us growing at around 1%, that is probably the biggest factor in why our currency is as low as it is. Our final chart on this is one that will show you that our currency is sitting at around 69 cents. There it is. Look at that fall off since it looks like, if I had to look, September, a real large fall off. And that's when Canada really started heating up with the cuts in interest rates. And that's when our dollar really fell off that cliff. And boy, is that a cliff. Our third point, corporate earnings, something that individual investors should be looking towards. Corporate earnings season is kicking off, usually kicks off with names such as Delta Airlines and the big banks in the US. We're going to get big bank earnings shortly, but a few names I wanted individual investors to have in the back of their minds. First one, JP Morgan. Let's pull up a chart of JP Morgan, largest US bank, one of the largest banks in the world today. You can see how well JP Morgan stock has done, slightly off its all-time highs, but has done extremely well. And I think JP Morgan is important to focus on because it's going to give us or tell us how the US economy is faring. Who else but to go to JP Morgan, the largest bank, to give us the pulse of the US economy. So let's keep an eye on JP Morgan, and they're set to report earnings at the start of earnings season. Next chart, Alphabet, another what I believe is a good indicator for how well the economy is doing. They do a lot of different things, obviously, search and ad search and generating revenues and on the cloud. And their cloud business has been growing, and artificial intelligence. And they're even involved in Waymo, driverless cars. They're pretty much right across the board, their browser and everything. So I think Google or Alphabet is a pretty good indicator, a name to watch to see how their earnings are looking like. And we've seen Alphabet stock move significantly higher coming out of, I guess, towards the end of November. December was a good month for Google or Alphabet stock. December, it's kind of been a bit flat, and January starting off a little bit flat. But overall, I think it's a name you want to take a look at. Next chart is a chart from our favorite fruit, as I say, Apple stock. And being the largest company in the world today, taking back the #1 ranking as the largest by market cap, almost hit $4 trillion recently. I think the stock has to get to 264 before it becomes the first $4 trillion company. It was the first to 1 trillion, 2 trillion, 3 trillion, and there's no reason to believe it won't be the first company to 4 trillion. and it has taken back the lead in as the largest company in the world. So obviously a big company or an important company to watch. And last but definitely not least, Amazon. Amazon, what don't they do, right? Everything from pharma to food with their Whole Foods to pretty much anything. Uh, them as well as Walmart, biggest retailers in the world today. Amazon being the biggest online retailer, but they're also AWS, which is their cloud. Uh, they're in, obviously, they have their AI business. You name it, they do it. Very important company for us to figure out the pulse of the economy and get a good indication as to how things are doing. So overall, corporate earnings season is about to kick off. I think if you look at that, if you look at economic data, as well as what the dollar and interest rates are doing, I think those are the three things that you need to consider before you make your investment decisions over the next couple of weeks. I love this acronym, Batman. I can't help but to think about those movies, or when I was a kid watching cartoons and watching Batman. He was one of my favorites. So to get this Batman acronym is fantastic. And here you have it. What does Batman stand for? Broadcom, Apple, Tesla, Microsoft Meta, so two M's, Amazon, Alphabet, two A's, and Nvidia. And we've had, as I said, off top of the show, we had FANG, we have the Mag 7. How does this, I guess, acronym differ from the ones of the past? And really, I would say it doesn't differ much at all, to be honest. It just, you added a few more names. We added a few more names. And why is that? Well, because of the success of a name like Broadcom. They came out with earnings, and their earnings were fantastic. Their outlook was fantastic, and they became the latest trillion-dollar company in the market, one of the largest companies in the world. So, of course, we have to add Broadcom to the mix. All the other names have pretty much been on our list in the past, just kind of mixed in a different way. But overall, this is a tech, this is a tech movement. This is about being in technology, being invested in big cap technology. That's really all that needs to be said. We have our first chart here, which shows the Batman stocks. And here you have them, right? This shows you how powerful and how big this group is. Market cap of Apple, as you can see there, the biggest, 3.68 trillion, followed closely behind by Nvidia and Microsoft, over 3 trillion as well. But then you have the 2 trillion club, Alphabet and Amazon, followed by the $1 trillion grouping, Meta, Tesla, and Broadcom, which is, as I said, new to the trillion-dollar party. So this tells me that if you're going to look at growing your wealth, these are the names I think you start with. And yes, they are all pretty much tech companies. You could make the argument about Tesla and Amazon is it truly a tech name, but I think they can be looped into this group of tech. And for anybody that's saying, well, I'm just going to move away from technology, I think it's too high. Well, I think you're going to miss out on some significant gains even in 2025. We know that tech has led the way in 24 and 2023. I think it's going to have or play a big part in gains in 2025 as well. May not be as large, or the gains may not be as great as we've seen in the past, perhaps due to high valuations. But this is the area of the economy that is growing and growing and growing. We're hearing from the likes of Nvidia that the growth just continues. Apple and names like Meta just growing fantastic numbers. And I don't think that's going to change. You can see here, earnings growth, Apple 19%, Nvidia 52% growth, and Tesla 37% growth. Unbelievable. You have some of the others like Alphabet and Amazon. When you look at it from a PEG ratio, keep in mind PEG ratio, price to earnings to growth. Obviously, the lower the ratio, the cheaper the stock. Nvidia on our list is the cheapest name, followed, I guess, by Broadcom, 1.3, Amazon. So even though Amazon trades at well over $200 a share, a lot of people would say Amazon is still fairly cheap based on certain metrics that you're looking at. Broadcom as well. NVIDIA, when you take out on a forward earnings multiple basis, it's probably trading somewhere around 36 times 2026 earnings. So is that cheap? Well, the company's growing at 52% and your multiple is around 35, 36. Well, I would say that pretty much growth at a reasonable price. So for me, that's what I look at, as I've said many times, growth at a reasonable price. We have some charts of some of the names, some of our Batman names. First one being Broadcom. Our Broadcom chart here. Look how well Broadcom has done. And that has actually happened right after Broadcom reported earnings. The market liked the earnings, came in roughly as expected, but their look ahead and the number that they put on their AI business was just astronomical, well above anybody thought. Broadcom, for anybody that is wondering, they do more customized chips versus NVIDIA. And in fact, when Broadcom surged, NVIDIA actually came down in the short term because some are looked upon Broadcom as a bit of a competitor to NVIDIA. Meta Platforms, formerly Facebook, our next chart. Facebook has just been an unbelievable stock. If you want to look at the far left to the top right, yeah, there have been blips along the way for various reasons. But when you consider over 3 billion people, 3 billion people in the world today are on Meta platforms every day, on Meta apps, I should say, every day. And there's only, what, 7.88 billion in the world today. So you figure how many of those people don't have access to the internet? Maybe a few billion. And then what's left? Well, you figure maybe Facebook or Meta touches half the population that has internet access in the world every day. That's just an unbelievable stat. And then when you factor in all that they're doing with respect to AI, with respect to their advertising and what they're doing with respect to Meta, with respect to their glasses. I actually have a pair of their Meta glasses right now, and a fantastic product. Their Meta Ray-Bans have artificial intelligence in them. All the different products that Meta's coming up with, unbelievable company to own shares of. Next chart is NVIDIA. NVIDIA here, you can see that the stock price has come down from about $152, which was its all-time high, but still just off. They had their conference recently. Jensen Huang, CEO, made some commentaries over the last couple of days about business going forward, and business really looks good with their new Blackwell chip, and their former chips are still selling like hotcakes. Can't get enough of NVIDIA chips. Overall, I wanted to show our next chart is an overall view of the QQQ, or the tech ETF. And you can see, even if you're not in these names, if you're just in tech in general, tech has done extremely well. So the big large cap tech names, the Batman names, make up a very large component of the triple Qs and a very large component of our next chart, which is the NASDAQ. So overall, when you're looking at what to invest in going forward, perhaps you want to look at Batman, the acronym Batman, and figure out what stocks in Batman. And there they are again. Are any of these companies worth owning? Are any of these companies cheap relative to their growth rates, their PEG ratio? I think that's important because, as I've said many times, I think if you're going to grow wealth, if you're going to grow your portfolio, even in this year, 2025, I think you need to have some technology as part of a diversified portfolio. Having the right expectations. And what do I mean by that? Well, what I mean is we've had now 2 years in a row on the S&P 500 where gains have been above 20%. We don't see that often, and it's been a fantastic run, and one that I think has really grown the wealth of many investors. Probably it's been the 2 years, I think, in my career that I can remember where I've seen the most growth of wealth of people's portfolios. The best 2-year numbers when you combine 2 years. So, should you expect another 20% gain? Well, I'm probably going to say not. I think there are a lot of things out there, as I've said already, higher interest rates, perhaps some uncertainty with the new Trump administration coming into power. Stronger dollar, that doesn't help in the corporate world. Global business out of the US. Strong dollar is not good for them as well. Valuations, probably the biggest factor that is working against another 20% plus gain year. But I think you're going to have a positive year, and I think you should expect a positive year, but maybe more so in and around that 10% plus or minus a little expectation. So maybe 8 to 10, maybe 10 to 12 in that range. And our one chart for this segment is annual returns for the S&P 500 since 1950. And you can see here all the gains that we've had and all the negative years that we have had. And for the most part, if you take the pulse of the markets over that period of time, so we're talking, I guess, 75 years or so, you're looking at, I would say, one challenging year out of every 5, maybe 2 out of 10, 2 or 3 out of 10. And so when you have that in mind, you're looking at hopefully growing wealth, growing your portfolio 7 to 8 times out of 10 years. And with that in mind, I think that is a very powerful thing. That means you're going to be making money. But yes, there'll be times when, you struggle, like we've seen in 2022 and we saw in 2008 and we've seen in other years as well. But those years tend to be followed by great years. And you can see the numbers on the chart. As I say often, the markets tend to take the elevator on the way down, but the stairs on the way up. What I mean by that? Well, the declines are sharp and brief, and the uptrend tends to be long and a little bit slower. So it gives us more time, just more time to get into the market to enjoy the gain. So expectations going forward, yeah, I think you should expect a more average year, something along the lines of as I said, 8 to 10, maybe 10 to 12 if we can squeeze out a little more. Keep in mind the S&P 500 on average makes about 8-ish%, 8, 9%, and the TSX averages somewhere around 7.5. So if you have that in mind, I believe you would have the right expectations. And that way, you're not surprised by the end of 2025, when we ring the bell on 2026, you're happy at the returns that you've had and your expectations matched what has gone on this past year. Confidence in the markets. I think you can have confidence in the markets, even though we're entering 2025 on a high note. And I know some people have asked me, Allan, should we be sellers heading into the new year? We are at highs. Well, my answer is, how do you know that 2024 highs aren't the lows for 2025? That we're not going to see another gain in 2025? Keep in mind, we came into 2024 on a high from 2023, and look what happened. So I think to sell just because we're at a high, you don't know that the market and your particular investment that you're talking about, your portfolio, is going to make new highs. We know markets go up over time. So that means, and that should mean to everybody, that yes, your portfolio is going to go higher over time if you own good quality investments. So what is an investment strategy? We have a few points to show you here. And we can pull them up. There they are. Remain cautiously optimistic for 2025. What I mean by cautious, I mean don't expect the 20, 30% gains that we've seen, or at least some investors have seen over the past few years. Look at it as more normalized growth. As I said in the previous segment, 8 to 10, 10 to 12. If you can get those types of returns on a growth portfolio, I think you would be in good standing, and you'd be able to consolidate a lot of the gains that we've had over the past few years, and you wouldn't be giving back any of those gains, which is the fear that many investors have. I think you want to stay diversified. You want to not chase the hot investment of the past, which is number 3. Those two go together. You want to stay diversified. And I can't tell you how many times people say to me, you know what, Allan, why are we in this pharmaceutical name? Why are we in this retail name? Why don't we just buy tech? Because that's going up every day. Well, you can't do that because every name and every sector has its day. There are some days that are good and some days are not so good. Yes, tech has been the leader the last few years. But how do we know tech's going to be the leader this year? So you want to stay diversified. We're coming into the new year, and pharma seems to be a very cheap sector. I think we want to look at pharma for 2025. A lot of cheap names there, like a Pfizer, like a Bristol Myers, paying good dividends, and also extremely cheap. Pfizer trading below a 10 multiple right now. And we know what they're doing with their business, getting into the oncology area. So stay diversified and don't chase the hot names of the past, like a Palantir. Palantir has been one of the worst performers over the past few days. For those that don't know what Palantir does, they've been gaining based on AI and their contracts with government and their exposure to AI. They've been a very big AI play for the last bunch of months, and the name has sold off a little bit recently. But there are other names that have been quite hot. Don't chase those names. Stay disciplined. Stay diversified. I think that's really important as part of your investment strategy. Sometimes invest gradually when markets are at all-time highs. What do I mean by that? I don't mean you can't be fully invested. And for many investors, they are fully invested, and that's fine. If you're diversified, that's fine. But sometimes if you have a very large sum of money that you're putting to work in the markets, maybe you want to take an initial investment in an investment idea. And then if it goes down, you buy more. If it goes up, well, you're already invested in that idea from the start. And so you will make money based on that. So investing gradually into the market sometimes does make sense, especially if you're looking at a big or a large lump sum of money that you're adding into a portfolio to be invested in the stock market. So investor confidence. I think you can be confident. There's a lot of reasons to be confident, a lot of reasons to be positive about this upcoming year. Yes, a lot of unanswered questions as well. And that just makes it fun, I guess, right? And just gives us the ups and downs in the stock market. I know people don't like the ups and downs, but the ups and downs will always happen. Portfolios will never go straight up, will never go higher in a straight line. So you have to be confident. You have to be willing to understand that markets don't go straight up all the time. And if you can do that, you can be invested in the stock market for the gains that I believe you will hopefully have in 2025. Quick hits, part of the show where I talk about 3 things that have been in the news that many of you may have seen. First one, Nvidia chip stocks were popping off, as we say, moving a lot higher after Foxconn. Now, Foxconn is the largest contract electronics maker in the world today. They are the largest assembler of Apple products in the world, and they made a lot of money this past quarter based on AI servers and the whole AI boom. And so when they did well and they announced a pretty good number, all the tech stocks, the chip makers in particular, went significantly higher. The second one, Trump denies report that his team is eyeing a pared back tariffs. There was a report out, I believe, of the Washington Post that Trump would consider not going through with his extensive tariff bill or what he wants to do with tariffs, but he has said that that is not true. Santa Claus rally. Did the Santa Claus rally happen this past year? Quick answer, no, it didn't. But there's a reason for that, and that's okay. So let's get to the first one. First quick hit on Nvidia. As I said, we have an Nvidia chart here, and you can see that Nvidia really moved higher at the start based on the last few days, based on Foxconn's earnings. And as I said, you could extrapolate this to many of the chip makers. AMD moved higher, Micron moved. Any company, or most companies, I should say, that were or are chip creators, makers, producers, anyone in the semiconductors really benefited from Foxconn and what they had to say. We've seen tech stocks, especially chip makers, fall in the last day or so, and that's more on the macro. That's more on the idea that U.S. economy is showing strength, and because of that, there may not be as many interest rate cuts this year, and so that has brought down some of the tech companies. But make no mistake, Foxconn giving us a very good indication that data center, AI, is definitely booming and moving forward. Second quick hit, Trump denies this idea, this thought in the Washington Post, I believe, that said that maybe he'll only put tariffs on certain products coming out of Canada and Mexico. Our next chart here, one of my favorite charts, very colorful chart. You could see how much total value of U.S. goods imports in 2023 by country. Mexico, biggest, 475.2 billion. And you have followed by China, and then Canada. We were the third biggest. And then you have all the other countries, Germany, Japan, Korea, Vietnam, Taiwan, etc. And then the rest of the world, 1.1 trillion. So obviously, tariffs has been the talk. And if the president-elect, the new president coming into office, goes through with his tariffs, not only will it affect us here in Canada, but it will also affect the U.S. as well. Our third point, third quick hit, Santa Claus rally that everybody waits for, looks for at the end of the year. Unfortunately, it didn't happen. And I believe for a good reason. And that reason simply was the gains that we normally had at the end of the year, they just came earlier this year. They came in November, beginning of December versus the end of December. And that's okay. You know, as I said on earlier shows, if we could squeak out a 1 to 3% or 1 to 2% gain on the markets, I'll take that for December to end a really good year. And we have a chart. I love that picture of Santa riding his with his reindeer up the chart, up the S&P 500, riding it higher. We have a chart, S&P 500, and that shows Santa Claus rally at the end of 2025 really wasn't much of one, fizzled out towards the end of the year. So 3 quick hits, 3 things that perhaps people have seen in the news that I wanted to touch upon, and 3 things that, again, you know, when you're looking at your portfolio, what does it mean? Well, hopefully I've shed some light on the meaning of 3 quick hits that we're seeing in the news today. What's my take? This is a part of the show where I take, it looks like our show has gone a little longer as always, a lot of information to start off a new year. So I'm going to take one question from our audience. And this one looks like it's coming from social media. Canada's 2024 rate cuts outpaced all other top 10 traded currencies. What does this mean for the loonie? Well, we had a good illustration on that earlier in the show. And that means that the more we cut, the faster we cut here. Bank of Canada cuts rates. What does that mean? Well, it means it weakens our loonie. And we've seen our dollar fall well below 70 cents. It was actually bordering on falling below 69 cents at one point in time. And then it regained back up to 69.5 cents. What do I see going forward? If Bank of Canada continues to cut rates as aggressively as they have in this past 6 months, then I think our dollar will fall further. Could we see a 68 or even a 67-cent dollar? Well, I think that's going to be for the Bank of Canada to tell us, because I believe the Bank of Canada really and truly will have the biggest effect on our dollar. Yes, they want to stimulate our economy, but I just don't think they can continue to cut rates as aggressively as they have. So with that, I want to say thank you to everybody once again for tuning in to our show today. I hope it was informative for all of you, and I hope everybody can take at least one thing away from my show or our show this afternoon. And as always, we will have our next show Wednesday at 12 noon, same time, same place, and that will be on January the 22nd. And I look forward to seeing all of you again. And until then, happy investing.